Good morning, good afternoon. Welcome to the August mortgage market update. I wanted to come on today because there's a lot going on in our industry and we wanted to bring it to you first, make sure you know what's going on. So a couple things, let's add this here. All right, about almost 2 weeks ago now, on August 8th, we actually topped $1 trillion in the US in credit card debt. Now, that's not good. We knew this was happening. We knew it was going to continue to happen, but we knew it was coming, but it officially happened. And it seems like it's actually the higher incomes are putting more on their credit cards than the lower incomes. But when you break it down to what they're putting on their credit cards, look, especially under 50,000, day-to-day expenses, retail goods, vacations and entertainment, and then of course emergency expenses. So emergencies, you got to do what you got to do, but it's just to show you that people with higher incomes think they're making it, so they're not afraid to spend it. But yes, we topped $1 trillion in credit card debt on August 8th, and that was the highest that we have ever been. Now, I want to show you something else. This is an article from the Wall Street Journal today. And look, car prices might be unsustainable for buyers. Surging loan delinquencies signal that many consumers can't afford their auto loans. Now, why is it that they can't afford their auto loans? Let's take a look at this. It says here, 5 years ago, there were a dozen models of new cars that sold for less than $20,000. In 2023, there was only one. One car now can you buy for under $20,000. That's just crazy. Think about how much the price of everything has gone up. And then when you look at today's average car loan has a monthly payment of $750,000, and that's with an interest rate of 9.5%. These are new cars. Average interest rate of $750 and average monthly payment of $750 with an average interest rate of 9.5%. Last statistic I heard, I think it was about 17% of car loans were over $1,000 a month. Now, used cars has an average interest rate of 13.7%. And this is also figuring the average term now is nearly 6 years. I believe you can get an auto loan out to even 8 years in some cases. So, they're just going to keep pushing this out further and further to try to make cars more affordable. So if you don't need a new car, I would not suggest going to get one. Now, the thing is, when this happens, credit will become tighter and tighter as this goes on. And when credit becomes tighter and tighter, home equity lines of credits are going to be reduced. You're going to see credit card limits get reduced. And it is a bubble that has to burst. And when it bursts, it's going to be ugly. So we're just trying to get out and let you know what's going on in the market. Rates are not going to be coming down anytime soon. I do think it's very possible you're going to see mortgage interest rates hit 8%, maybe even a little bit higher. It depends on who you're dealing with. But all this is going to happen because rates are not going to come down as long as there's a good, strong jobs market and a good, strong credit out there. And the thing is, people are still spending right now. And when they spend, we need the labor to deliver the goods and services. But when people finally run out of money and max those credit cards, have no savings left, it's going to cause them to stop spending. And that's what's going to cause the job market to actually get hurt. And that's when you're going to see things get really, really ugly. Now, to top it all off, don't forget those federal student loans, they start September 1st. We are days away from federal student loans starting to charge interest again. Invoices go out in September 1st, and they are for loan payments due starting October 1st. So how's that going to play into it? I think the people that have these student loans have forgotten about them. It's been over 3 years that they haven't had to pay on them. If you look at the charts of when people stopped paying those federal student loans and when the car loans really took off, it's right there. They stopped paying those loans and they all went out and bought cars. So now they got the student loans starting, and here we are. It's going to cause issues. Also this week, we do have the Jackson Hole Symposium that is starting on Thursday through Saturday. Jerome Powell is speaking on Friday. You're not going to see any big news until he speaks, so we'll see what happens with that. And I do just want to show you, we use MBS Highway to keep track of mortgage bonds. And look at this. This is your mortgages. mortgage bonds went down, 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 down since, I mean, look at August 7th there. So past couple of weeks, we have been hurting every day, getting worse and worse. So when mortgage bonds are going down, that means your interest rates are going up. And you can always keep an eye on mortgage rates at Mortgage News Daily. You can click on mortgage rates. Now they're showing 7.375%. Keep in mind that does not show you what the points are that people are buying for that interest rate, because these all have points attached to them. So just kind of keep that in the back of your head. But things are definitely costing more right now, whether it's goods and services, mortgages. But it's also a really good time to buy a house when that happens, because when interest rates go up, there's less competition out there. People are less likely to bid over ask, and they're just less likely to buy at all. So now is your time to get that house under contract, settle on it, and refinance down the road when rates do drop. I do think they will drop. It could be a year or two. Nobody really knows. Anybody that says they knows is lying to you, because they don't. But you got to be comfortable with what that payment is today, just in case. What if rates go to 10% and you cannot refinance? So any questions, don't hesitate to reach out to the Rebecca Foote Mortgage team. We are here to help you. We want to help you build wealth through real estate and put you in better financial situations that are better for you. So if you are somebody with high credit card debt right now, the average homeowner has $184,000 in equity in their home. So a lot of people do have equity in their home that we can tap into and pay off those high credit cards. Because the thing is, your 3% interest rate on a mortgage does not matter if you are paying 20-25% on these credit cards. So your blended rate is not very good. You're actually better off in most cases to refinance, even at a higher interest rate, and get rid of those credit cards, get your cash flow better, put yourself in a better financial state, live within your means. If you have any questions, don't hesitate to reach out. I'm Rebecca Foote, your mortgage queen, and I look forward to talking with you soon.